I'm talking to you today from Top Gun Options, and what Top Gun Options is an educational resource for options traders. We have some great, well, at least I believe, some great people here, some really sharp minds about options trading. We've got Wiz Buckley, who is not here today. We've got myself. We are constantly working on being options traders, giving you trade ideas, working through portfolios, and really digging into some options trading. So what I'm going to do today is actually kind of brief. I mean, for those of you who've seen me before, you'll know that I tend to run on and on and on. But today is going to be a pretty focused little presentation. I want to give you a taste of what we do here at Top Gun Options. Now, one of the things we're talking about or promoting today is our Full Throttle series, which actually is a kind of comprehensive program for traders, options traders, that you can get involved in. Now, what that does is it has a series of educational seminars which are focused on building skill sets around trading options. It's got several of our different programs wrapped up into that, including my advanced live trade brief, Matt's primary live trade brief, which is every week we get together, we're talking in depth into trades, managing a live portfolio of trades. We are sending out trade alerts, all these different things. Now, let me see here. My gig here is the live trade briefs and alerts and the Full Throttle education. So every Thursday at 9 o'clock we do education. We also get alerts throughout the week. And we build on market-appropriate tactics. Now, I'm going to tell you what, I'm going to just jump out of here, and slides are boring. And I'm sure you guys are going to get more than enough slides today. So let's jump into a little bit of the meat of what's going on out there right now. What I want to do is give you a little bit of a peek into my mentality, into my thought process, and hopefully get you thinking about trading a little bit. Now, we're in a market that is certainly a little bit uncertain at this moment. And we've been going for years and years in a strong bullish market, one of the strongest bullish markets we've had pretty much forever. And we're sitting here with all kinds of risks coming up in the future. I'm sure that all of you are looking out into the future saying, you know, when is the market going to start correcting? When's it going to, drop? Or maybe is it going to continue to go forever? I don't know. I'm not some kind of anarchist slash Armageddon predictor or anything like that. My personal view is I read what the market's doing right now, and I try to craft a portfolio of trades that takes advantage of that. Now, let's just take a look here over the last couple of weeks. And just as a broad indicator, the SPYs. SPYs, S&P 500, nice broad index, gives us a good feel. The fact is, despite all of the craziness and all the weirdness and all the Greek jumping out of the euro and oil prices moving all over the place and threats of interest rates going up, we've had a generally long-term positive bullish trend. Now, the last couple of weeks, let's just shift down to a little bit narrower time frame, we've had a bit of a minor correction. By the way, I personally think this is healthy. I think the market needs this. We need to knock around the market a little bit, shake out some of the weaker players, and hopefully kind of get a clear picture of what's going on in the future. What I don't want to see happen is us go up and up and up forever until finally everybody says, the heck with this, I'm getting out, and I am going to run for the hills, at which point the market crashes 20%. I don't like those. Because, number one, that means that people aren't going to play in the markets anymore, and I need somebody to take the opposite side of my trade. Now, I try to look at the market, educate myself as much as possible about what's going on, and then I try to make some good, smart decisions. Now, the good, smart decisions part of it comes into finding trades that fit the market condition and effectively give me the opportunity to make as much money as I can while still being safe. And also, I try to look at things from a portfolio view of trades. Now, this is something that I talk about a lot in my live trade brief class, and I actually teach in my Full Throttle course. You don't need to look at every trade. In fact, I think well, excuse me, let me rephrase that. It didn't quite come out right. It's not so much about every individual trade. As a matter of fact, I find it a lot better to think about your trading as a portfolio. You're trying to generate and create an ecosystem of trades, 10, 12, 15 trades at a time, different targets, well diversified, different strategies, and different exposure to market risks. You want to create a situation where the majority of your trades are going to win. Guess what? Some of your trades are going to fail. It's reality. You have to live with that. But managing that and designing a platform or a portfolio of trades that works well, is resilient in crazy market conditions, is what helps you be strong over the long run. Now, as I'm building my trades out, I try to take the opportunity, like we're in right now, to find good situations for specific trades. I am a little worried about what's going to happen next to the market. I am a little worried that we are going to see a crash sometime soon. Excuse me, no, let's not use the word crash, correction, larger correction. Back in October, we were, basically the market proved that it has the ability to very, very easily do a 10+% drop. That's what that was right there. If you don't think we can't do another one of those right away, you really ought to reevaluate your view of the market. Now, on the other hand, the market's been telling me up. So in general, I try to play along with that. I'm going to show you two different symbols right now that allow me to kind of play along with this theme of what's going on in the market and how I would play the market right now to get the best advantage. And ideally, now I'm coming into this completely cold. I'm looking at two different symbols, so who knows how it's going to work out. But ideally, walk away with two different trades. So let's walk through the first one. First, Evil Empire, Goldman Sachs. Now, of this. As a matter of fact, I have a fairly serious hatred of this company. Reason for that is that they were a major competitor of me when I was doing some of my stock arbitrage and market making trading, and pretty much pushed me out of the business, which is what Goldman Sachs does. Now, I don't hate them that much. The reality is that's what the market tries to do. And it was probably a good time for me to get going because I couldn't spend $3 million every quarter on computers when they could. But I love to make money. Call it a revenge trade. I love to make money off of Goldman Sachs. One of the things that I like is the fact that right now they are very solidly consistent. Look at this. Take a really close look at what Goldman Sachs has done over the last couple of weeks. That's very, very recent period. There. Now keep that stuck in your head. That is the market. That's the SPYs, S&P 500. What I'm looking for is a stock that is going in the general trend of the market. It is doing its own thing, and it's not being dragged down when the market gets dragged down. Now, why do I want this? Well, I try to diversify my portfolio. I try to create trades that, number one, have a good opportunity for profit, but number two, if the market falls apart, it's not going to drag every single trade in my portfolio with me. Now, don't get the idea that I'm just going bullish on everything. I actually have a very decently balanced portfolio of bullish trades, bearish trades. I have some long volatility trades. I have some short volatility trades. I have some time erosion trades like iron condors. I keep a good variety of trades. But right now, in this case, I like Goldman Sachs because it is strong when the rest of the market's weak. And if things were to fall apart, I'm not saying Goldman Sachs won't go down, but guess what? It will not go down as much as the others. So, and that's going to give me time to manage my trade and manage my risk. Now, let's think. Do we want to put on some horrendously complicated strategy in Goldman Sachs? No, actually we don't. We want to do something fairly simple, straightforward, easy to manage, easy to understand, lay it out, get a good trade out of it. So I'm basically going to be working with a bull put spread here. Now, let me just double check something real quick. A couple things, whenever I'm looking for a bull put spread, These are some of the things that I like to check out. They don't make or break the trade. Number one thing I want to see on this trade is a nice, good, solid trend. You'll notice that I don't have a ton of lines on my screen. As a matter of fact, that line right there is just showing me where the strike is on one of my trades. Don't have a lot of moving averages, don't have a lot of Bollinger Bands, average true ranges. I actually like things simple. I want to find when I've got a consistent, solid trend, compare it to the rest of the market, look for some independence of price movement, and ideally set up a trade that works based on that. I'm going to set up some good places to manage risk. I'm going to have a stop loss so that I've got a plan for getting the heck out. And I'm going to try to figure out whether or not this trade makes sense financially for me. So a couple of things we need to work through. Let's just poke around with the trade now. I was going to mention there's a few things I look at. One, implied volatility. Whenever you're doing a credit spread trade or a high probability credit spread trade or a short volatility trade, if you want to look at it that way, what you're doing is you're being paid to take a risk, and that risk is on what the market is going to do or what the stock is going to do. What tells you how well you're being paid? I mean, most of you understand fundamentally that you want to be paid a high amount of money to take as low a risk as you possibly can. So, high money, low risk. The money you're getting paid directly relates to the implied volatility. So I have this little chart down here. It's a very simple one. It's got two numbers on it, historical volatility and implied volatility. Implied volatility is just generally measuring what the pricing of the options are right now. And it does a little formula across all the price series, all the options chains, and figures out what the average implied volatility is. It tells me that based on the average implied volatility of the options over the next 1 year period, you can see this number right here, there is a one standard deviation range of 20.7% up and 20.7% down. That's the risk I'm being paid on. Number two is this red line, and this is basically historical volatility. Now, this might look a little different from yours. This is using what's called the Rogers and Satchel method. It's a little cleaner version of historical volatility. Join up with our service. I'll give you the indicator. I'll give that to you so you can plug it into Thinkorswim. But what does historical volatility tell you? Historical volatility tells you how quickly the stock price has been moving. So if there's nothing out there to change the stock price the way it's moving, it's probably going to move relatively similar to the way it has been moving. I'm not saying it's going to keep going up or go down or whatever, but the pace at which the stock is moving is going to be very, very related to the historical volatility. So I have implied volatility of 20%, historical volatility that calculates out to about 14%. So if I'm being paid on the risk that the stock is going to have a one standard deviation range, basically 68.2% chance it's going to stay within 20% higher and 20% lower of where it is right now over the next year. And the reality is that I'm measuring the stock moving at a 14% pace. I actually have a really good edge in this trade. I am getting a nice little advantage. Now, I don't need that advantage, but it's nice to have. Other thing I want to know is the direction nice and clear? Now, I personally think in this case it is. It's a nice, solid trend up. Great. Everything's laid out. Last thing is I don't ever put bull put spreads on over earnings announcements. Just a basic thing. That's the wrong type of trade to have over an earnings announcement. It's too dangerous. You're not being paid well enough to take the risk. You're not being protected well enough. So I want this bull put spread to expire before the earnings announcement so I'm not affected by that. All right. And the earnings announcement is roughly on the 16th of July. No problem. So we can't use the July monthlies, but we can use the July 2s. Going to the options, going to July 2, and hold on. I don't really, as far as trades are concerned, they call me the advanced options trader, but in a lot of cases, what I do is fairly simple. The advanced part is trying to find the right opportunity, trying to find the right situation, and knowing how things are going to fail so you can plan on managing the trade well. As far as I'm concerned, I don't need to do anything horribly complex to make my money on the trade. I'm going to look for a delta of around 20. That's a comfort zone for me. 20, in this case, a 19 delta means that I've got roughly, based on the pricing of the options, an 81% chance that this trade is going to be successful. Now, remember, that's based off the pricing of the options, which is way overpriced relative to the actual historical volatility. So my real odds are much higher than 81%, probably closer to about 87 to 88% that this is going to be successful. So 19 delta looks like a good spot, going short. I'm going to protect myself. In this case, I'm taking a $2.50 spread. Narrower spreads are better because you get a greater return on your investment. We don't have anything narrower than $2.50 here. I'm going to go with that. Now, you have to be a little careful about that. You go too narrow, and your overall credit gets so small that you get chewed up by commissions. Just keep that in mind. Be aware of that. So, I've got 32 cents. Beautiful. What is the trade looking like? I'm looking at the July 2s. Those are 31 days in the future. Let's run some numbers to make sure that this makes sense for our portfolio. We've got $2.50 minus 32 cents in credit. Our overall margin is $218, or actually, these are options, so times 100, $218. That's for one of these. But silently in just a second also. Sorry, taking a little notes as we go here. What are we going to make on this trade if we run the trade and we go all the way to expiration? It's one of the first questions I want to answer. So, $32 per bull put spread divided by $218 in margin. We're going to make 14.6%. Okay, 14.6%, 14.7%, that's not a bad return. Over 31 days, let's see. I'm making just shy of 0.5% a day. Now, in a lot of cases, I have people come up to me and say, well, I'm making this small amount of money for taking a large risk. Well, what are you doing when you buy a chunk of stock? You expect that the stock is going to go up 10% over the year, and guess what? If that stock announces that they've got accounting fraud or get delisted or something like that, you've lost all that money. We don't trade that way, though. None of us trades that way. So don't look at it that way. Look at it as, how are you going to manage your risks on this trade, and how are you going to deal with the trade on a real basis? Yes, this trade could go against us. Absolutely. I'm not going to lie to you, blow smoke. It has some risk in it, but the risk is actually fairly low. All we need to do in this trade is stay above a 200 strike between now and the second Friday in July. Let's just do a quick little test here. That would be Friday, July 10th. And remember, the strike is 200. This is something I like to do that's not terribly technical. Call it a sniff test. Does it look reasonable that Goldman Sachs is going to stay over 200 between now and 31 days from now? We've got a very strong trend, which, let's be real, it could break, it could fall back down. We have not actually been, we're probably about 30 days out, maybe a little less, 28 days out since we were at the 200 level. That's roughly there. If it maintained its same price of movement but it's headed straight down, I would still have quite a bit of room before that actually came down here. And remember, if I believe the trade is going to fail, I'm going to close this trade out. I'm going to walk away from it. I'm going to minimize my losses. But I am overall pretty comfortable that Goldman Sachs is going to be over 200 between now and July 10th. Pretty easy premise. Now, when I'm managing the money, by the way, I manage money, I do a number of different things. I've got my own portfolios, I've got some other people's. When I'm managing money, I'll dig into this deeper. I'll research Goldman Sachs. I'll make sure that there's no explicit risks popping up anytime soon. I'll get to know the symbol, I'll get to know the trade. I've already done that. This is a quick session, so I'm going to move through that fairly quickly. Right now, I think that Goldman Sachs is a really good possibility of staying above that 200. I am not looking to make some kind of home run. I'm not looking to expose myself to unreasonable risks. I want a high probability trade that I'm going to walk away with a just shy of 15% over 31 days. That's pretty good money. You know, getting back to the calculator, if we wanted to make this real flashy, I could say if I'm making 0.47% a day and I did that all year long, that's 172% a year. Now, that number's kind of, I don't know, that's not real. But, you know, if we wanted to get flashy about it, that's what we'll be looking at for a return if we can continuously do those. So that is a darn good trade. Now, let's figure out what our risk limits are on this, how we're going to trade this, making an actual plan for getting the heck out of this thing, making our money and protecting ourselves, and also how we're going to think about this overall in our portfolio. Number one, we've got our reason for entering the trade. Solid trend. No explicit risks that are going to be popping up. We've got lots of opportunity here, and we believe that there's a very high percentage chance that this is going to stay above 200. All right, there's our thesis, our reason for the trade. We've got an edge in the trade. We've got high implied volatility relative to the historical volatility. That gives us another edge and a chance to have a higher probability than what we're even looking at for making a profit. Now, what are we going to do about the right size of this trade, which is extremely important, and the risks in this trade? I, for one, don't try to get overly complicated. I want to try to find a nice place to put my trade, to put my stop loss, that if this trade were completely to go to heck very rapidly, I would just have a spot where I stop thinking and I get out. Second thing I want is some intermediate point that I call a risk alert. Something that says, you know, this thing is not doing what I expected it to do. And, you know, if I'm managing 12 trades, 13 trades, I've managed portfolios with 50, 60, 100 trades at a time. I just want to be focused on the ones that are, you know, either doing really well or the ones that are not doing well at all. So I want to alert myself as to when this thing is failing. All right, so I'm going to put a stop loss in this about 30% down. And then I'm also going to use that for sizing my trades. So our risk on this is $218 times 0.3. We are going to have a max loss or a stop loss point of $65 loss on each one of these. $65.40. Now, that also translates into 65 cents in increase in price. So going back to the trade, we've got a price of 31 cents. Add on 65 cents to that. We now have a price, a target price of 96 cents. So if I hit 96 cents, and then that will be a 30% loss in this trade on the margin I'm putting into this trade, I am going to stop thinking and I am going to get out of this trade. And why do I say stop thinking? Because it's really easy to deceive ourselves into thinking that a trade is going to recover. You know, we've got all this hope that things are going to be coming back. No, we can't do that. We need to have a plan. Now, before we ever hit that 96 cents, I would rather be out of these trades. In fact, I very, very, very rarely ever hit my stop losses on any of my trades because I want to be a smarter trader than that. Now, I'm going to put a second level out. Our entry price is 31 cents right now. I am going to put out a price, an alert for myself at about 65 cents. Now, there's nothing scientific about this. It's just putting it somewhere in the middle. I will be failing on the trade, but not substantially. I'm not taking a 30% loss. I'm probably about 15% down at that point. What do I want to do? As I approach that number, and I should be paying attention to my trades and reevaluating my trades, I want to ask myself a really clear question. Is the reason for the trade still valid? That's it. That's all you have to answer. Is the reason for the trade still valid? Now, If the market is just waffling along and Goldman Sachs pulls back against us a little bit, I could consider the reason for the trade still being valid. On the other hand, if the reason that Goldman Sachs is moving down and is moving against our trade is because a bunch of brand new news came out and Goldman Sachs is being sued by something, SEC is investigating them for fraud, Lord knows that could never happen with Goldman Sachs, any of those things, then the reason I have for the trade is no longer valid. You know, I had a good reason to believe that this Goldman Sachs is going to trend up and make me money. But the world changes. Sometimes it changes in ways I don't expect. If the world changes and I do my research and I figure out that Goldman Sachs now suddenly has a really strong reason to go down and against me, I don't want to be in this bull put spread anymore. I don't want to be in a bullish trade. So I close the trade early and I walk away. I don't try to adjust. I don't try to fix anything. I don't try to add any magic pixie dust to make the trade better. I walk away. I take my margin back. I find a symbol that works well, that doesn't have the problems that Goldman Sachs has. I make my money there. Once again, that's getting back to the portfolio view of things. So we now have our trade. We can put this thing on. We've got 31 cents credit. We have a risk limit of 65, or a risk alert of 65 cents, and a stop loss of 96 cents. I have my plan. Flip side of that is if Goldman Sachs were to shoot up really fast. Remember how I calculated out that we're making a little bit less than 0.5% a day on this trade? Well, we can have situations where the trade goes very fast in our favor. Goldman Sachs is trending up right now. I mean, it's a strong trade. Yes, the last day or so has been a little bit rough, but hops back on board that train up, boom, we might actually get out of this thing early, and that is a beautiful thing. So I would put a target on this of about 5 cents. The goal is that I don't want to wait all the way to the end of the trade to close this out. If I had Goldman Sachs move up very rapidly in the first 2 weeks of the trade, I could have the opportunity to close this out for 5 cents, make about 80% of our profits on this trade, walk away, and immediately turn around and create a new trade with the margin I received back to make more money. And that's a beautiful thing. And get into the habit of doing that. It's one of the things we try to do constantly. As I mentioned before, it's an ecosystem. It's a kind of garden of trades. You want to encourage the ones that are growing well, harvest the ones that are ripe, and kill off and weed out the ones that are dying. You know, and keep an overall portfolio of good trades. Now, one last thing we've got to do on this, because I'm not taking 10 contracts, I'm going to figure out what's the right size for this particular trade. Now, in the Advanced Live Trade Brief class, I run a $100,000 portfolio. It's a good example, paper traded portfolio, so everybody can see. You know, and by the way, we paper trade, encourage everyone to follow in paper trades because you need to be comfortable making your own decisions and you need to learn. And that's paper trading is a great way to learn. Once you are comfortable, you need to move and make your own decisions about your own portfolios. I don't want people just blindly following everything I do. I want you to learn from what we're looking at, learn from how we trade to the point where you're comfortable making your own trades. So we've got a very, very strong teach to fish mentality here at Top Gun. Now, $100,000 portfolio. I need to diversify that portfolio. I need to make sure that the risk associated with each trade isn't too large for the portfolio overall. It's actually fairly easy to calculate that. I've got a stop loss at 30%, and we figured out that that was a 65 cents or $65 per bull put spread risk. I don't want to take more than 2.5% risk against my entire portfolio, and this is how I manage and size most of my trades. So let's pull the calculator back up here. $100,000. I don't want to take more than 2.5% risk per, so 0.025. It's $2,500. I know that for every one of these trades I'm going to put on, I'm risking $65. So divided by 65 bucks. I can take 38 of these. I happen to like rounder numbers. I could go to 40, I can go to 35. In this case, I think I'm going to go to 35. And confirm and send. Boom. You know, that almost makes me feel bad. I hate it when I get filled too fast. It means I gave up money to somebody. But we just got instantly filled on that one. Now, it is paper trade. That's what we, that's what we follow here. But I would expect that a live trade, if you chose and it fits your portfolio, a live trade would get filled relatively quickly too. Please do speak to a licensed broker, registered investment advisor, before doing any live trading. That is not something we can advise you on just because of the nature of our business. But looks like it could be a decent trade. Now, going to move on to one more real quick. Going to look at it from a slightly different perspective. This was a relatively, what I would consider, short-term trade. I would love to see us out of this in about 14 to 20 days. If we can hit that 5 cents fast, that's wonderful. Take the money, walk away, put the money to, put your margin in that profit to use someplace else. Now, sometimes I want to have trades in my portfolio that are just kind of very, very long-term producers. So let's look at another one. EEM, Emerging Markets ETF. I love this symbol. This is an ETF. It's a basket of stocks. It's not necessarily beholden to any one particular symbol in this. It is emerging markets all around the world. You know what the beauty of emerging markets are, at least for me? The beauty of emerging markets is just about the time that one emerging market is doing amazingly well, another emerging market is falling flat on its face. That's the cycle. That's what happens with emerging markets. I've pretty much never seen all the emerging markets line up all at once and make a massive, massive move up or massive move down. They all kind of have their own little paths. Now, why is that good? Because if you look at this thing over the long term, it creates a beautiful sideways pattern. Now, this is 3 years. This is what I really like. This is going back all the way before 2011. And, even back here, it wasn't really doing a whole heck of a lot. It's still somewhat in that pattern. Now, back in 2008, certainly did participate in the crash down. But ever since then, this thing has just been basically floating along sideways. This screams an opportunity to make money for me. Now, there's a couple other things that I like about this right now. The current price of the stock, if I just line up on the current price of the stock right there, that line shoots right down through the middle of this range-bound trend that EEM has been on for a long time. So that means that I can set up a nice iron condor, ideally get my strikes outside the range of this trade, and create an opportunity to make some money. A couple other things I like. Once again, implied volatility 20% against a very, very small historical volatility of about 7.8%. We're being paid to take a very, very high risk, and the actual price movement indicates that it's a moderately low risk. Two very, very good things. Now, when I'm doing my live trade brief, I like to build out a lot of tools because I'm lazy. I like to have things that simplify my trading. So let me pop over here. Yeah, there we go. This is a little spreadsheet that I threw together, and it allows me to analyze iron condors very, very easily. So let's pump in a couple of numbers and let's see what we can do with an iron condor. Now, by the way, I'm probably not going to do the iron condor that most of you expect me to do. Most people expect to do about a 30-day iron condor, maybe even less. Maybe you're really adventurous, you're doing weeklies or bi-weeklies. I am not going in that direction, and I'll explain to you in a second why. Now, first of all, I need to enter in some pieces of information. Stock symbol, EEM. Forecast volatility. That is taking the historical volatility here and then tweaking it a little bit, saying what do I think is going to happen over the relatively near-term future on this. So I'm going to take 7.5% historical volatility, and I'm going to move that up to about 8%. Now, this is an extremely important number. And Excel has stopped working. Great. This might take several minutes. Okay. Okay, you see every Excel spreadsheet that I've got going right now. It's always the fun when you're doing live presentations. Things blow up. Come on. Yes, data analysis. Well, sorry for the distraction here. I'll tell you what, as this stuff is going in the background, let me talk about this trade a little bit more, then we'll go punch the numbers in and we'll take a look at what it means. Because obviously something funky just went on with Excel. All right, what would I do with this iron condor? Well, I want a trade that's going to generate me money, but I don't have to work much at it. You know, there's a certain portion of my portfolio that I just want it to generate me profits. And I don't want to have a high level of risk. In fact, I want a very low risk. I want to be able to avoid any kind of short-term price movements in the market. I want to be able to create kind of an income stream. I want to have the opportunity to improve on it at times too. So let's take a look at EEM, but let's look at a very long-term EEM trade. I've got the August 15th, 73 days out. That's a possibility. I also have the Septembers. Now this looks very interesting to me right now. 101 days in the future. Now, why in heck would I want to do something that long? Mainly because the longer term before I expire, the wider the strikes are going to be for the short portion of my iron condor. You know, for those of you who don't know, we're going to be buying a bull put spread, which is basically selling a put, going a little further out and buying a long put to protect ourselves, creating a bull put spread on one side, selling a bear call spread on the other. So shorting a call, going a little further out, buying a call, protecting ourselves, all with the same expiration, generating a reasonably high credit on the trade relative to our overall risk. And the way we make money is theta erosion, time erosion as we go forward in time. We want both sides of that trade to erode towards zero. Now, if the stock moves up very rapidly, we lose on the bull put side. If the stock moves down very rapidly, we lose on the bear call side. But we want to stay far enough away that this trade fails slowly. It fails gracefully. And it's very manageable. And more than that, it gives us an opportunity to make more money than you might think on the trade. So I'm going to take a look at September 2015, 101 days out. As a general rule of thumb, I go with about a 15 delta on my short strikes for entering the trade. Decent amount of open interest. I mean, EEM is an extremely heavily traded symbol. We have more open interest than we ever use. We're great in that. You will probably get fills without too much trouble. Bid-ask spread's nice and tight. I'm going to take the 35, which is the 35 put, which is a 15 delta. That's right about where my comfort level is. Higher the delta, higher the risk in the trade, more probability you're going to need to manage the trade. Lower the delta, lower the risk, but also lower return. So 35 is kind of my sweet spot. And in this case, I am going to take something a little bit wide of a spread, do a $3 spread. When you're doing longer term trades, the wider the spread, the more opportunity you have for making positive adjustments or doing an early exit on the trade. So in some cases, I would want to get down to $2, maybe even potentially even $1.50 or even $1. In this case, I want to go a little wider. So I'm taking a 35 by 32 bull put spread expiring in September. Do the same thing on the opposite side, looking for 15. I've got a 16 delta there. That's fine. I'll take that one. Got to short the 43.50 and $3 out. Got to go long the 46.50. I now have an iron condor. Let's see if I can put some of these numbers. There we go. All right, let's start punching some numbers into this and see if we can calculate out some of the risks and possibilities in this trade. $39.90. I'm going to ignore the number of iron condors right now. September 15th, let me see. September is 9/18. So that is the date that I'm going to expire. I'm going to get my strikes in. 32, 35, 46.50, and oops, short call is 43.50, excuse me, and 46.50. Now this doesn't give me, this is always a fun one. Actually, I'm going to just try send that. Come on, get me filled. All right, I'm just going to push this order just so that we can get a fill on this quickly. There we go. Now, I just did that in a paper trading account. If I'm live trading and I'm not constrained for time, I'm going to be doing it a little slower, trying to get my fills a little bit better. I just want to get my fill prices so I can analyze this. So I'm putting in the fill prices here. 35 strike, and 20. 48 cents. All right, let's run through what the spreadsheet tells us. And once again, I did this mainly so that I could do iron condors very quickly and analyze the risks. We are getting net credit of 48. By the way, I'm just doing 10 of these. Kind of random number, I haven't sized them yet. It gives me $480 net credit with a max risk of $2,520. I'm going to put the same 30% stop loss in this. I am not letting this get to max risk of this. Especially with an ETF, you're not going to see a gap all the way down far enough that you're going to lose a max loss on this. You manage the trade, you don't let it get to the max loss. So the return on the trade is about 19%. Now, we're looking at 74 trading days or 101 calendar days. 19% over that period of time doesn't seem to be great. It's a good trade. There's nothing wrong with it. 1/3 of a year and make 19%, I'll take it. But look at this. I have a 97% probability of being successful. What it did is it took the forecast volatility, calculated out what your odds are, and you actually have about a 97.56% chance of making that max return, 19%. You've got a 98% chance of being break even or better, because that's a little wider. And if you were to take this trade over and over and over again, you do what's called something called an expectancy calculation. The law of large numbers allows the average return on this trade. You're going to win some, you're going to lose some, but on average it tells you how much you're going to win. Our expectancy on this trade is about 18.29% or 1/4% per day. Now, I need to wrap this up because I do have to get going here, but let me just explain something on this. I don't actually take this all the way to the end. In about 60% of the time, or 60% of the length of this trade, I'm going to recoup about 80% of the profit of this trade. I'm going to see this thing go towards my max profit far faster than you would think on this trade. I'm also going to get some drift up and down, and I'm going to allow myself to adjust the puts up or adjust the calls down to actually add credit to this trade. These are the types of trades that we do fairly often.
We have about 1 minute left, if that.
Okay. Well, I'll tell you what, everybody. Thank you very much. This trade right here, I like this trade. It's a good trade. This is the type of thing that we do at Top Gun, or I teach in my class. We go in depth on this stuff in my Full Throttle series. And let's see here. So we'll just show you that. Okay, that didn't go there. Stop by Top Gun options. It's actually fullthrottle.com. There's Annie. There we go. Just shy of 2,000 for the year. Check out topgunoptions.com full-throttle. That's it. I appreciate everybody showing up for me. Thank you very much.